Walk through downtown San Francisco or Chicago or New York on a Monday. Look up. What do you see? You see billions of dollars of glass and steel. You see the monuments of American capitalism. But the smart money doesn't see monuments. They see ghost towers. Right now, nearly 20% of all office space in the United States is vacant. In some cities, it is closer to 30%. But the vacancy isn't the crisis. The debt attached to the vacancy is the crisis. Imagine buying a house, moving out, and then having your mortgage payment triple. That is exactly what is happening to the landlords of corporate America. We are staring down the barrel of a $1.5 trillion maturity wall. Loans that were signed in the golden era of 0% interest are coming due now, and nobody wants to refinance an empty building at 8% interest. The retail investor thinks real estate always goes up. The smart money knows that for the first time in history, prime real estate is about to go to zero. The landlords are praying for a return to office. They think this is temporary. They are wrong. This is a structural break in human behavior. I've been analyzing the data from Castle Systems, the company that tracks employee badge swipes in major U.S. cities. For 3 years, the line has been flat. We are stuck at 50% occupancy. The other 50% isn't coming back. Why? Because the leverage has shifted. Employees realize that commuting 90 minutes to sit on a Zoom call is insane. And CFOs realize that paying $100 per square foot for empty desks is bad business. We are witnessing the de-officification of the economy. In the Industrial Revolution, we moved from the farm to the factory. In the information age, we moved from the factory to the office. In the AI age, the office is in the cloud. The physical building is no longer a requirement for production. It is an optional luxury, and in a recession, luxury is the first thing to get cut. To understand why this crash is inevitable, you just have to do the math. It's a simple equation that is currently broken. Commercial real estate is valued based on cap rates, essentially the income the building produces relative to its price. In 2019, you could borrow money at 3% to buy a building that paid you 5%. You made a 2% spread. It was free money. But today, the loan costs 7% or 8%. If the building still only pays 5%, you are losing money every single month. You are negative carry. And here is the terrifying part. Commercial loans aren't like your 30-year fixed mortgage. They are balloons. They last for 5 years, and then you have to pay them back or refinance them. There is a $1.5 trillion wall of these loans maturing in 2025 and 2026. The owners have two choices. 1, write a check for millions of dollars to pay down the loan to make the math work. They won't. 2, hand the keys back to the bank. They will. We are already seeing it. Brookfield, one of the largest owners on earth, defaulted on prime towers in Los Angeles. If the biggest players are walking away, what happens to the small ones? So if the math is broken, why haven't we seen a mass collapse yet? Why aren't banks failing every Friday? Because of a strategy we call extend and pretend. Or if you want to be technical, delay and pray. The banks know that if they foreclose on these buildings, they have to sell them. If they sell them, they have to admit that the building is worth 50% less than the loan value. If they admit that, the bank becomes insolvent. So, the bank and the landlord make a secret deal. The bank pretends the loan is still good. They extend the deadline by a year. They pretend the building is still worth $100 million, even though the market says it's worth $40 million. It is a conspiracy of silence. They are creating zombie buildings, properties that are technically dead but still walking around on the balance sheet. But you can only pretend for so long. Eventually, the regulators show up. Eventually, the investors ask for their money back. But it gets worse. Many of these loans aren't held by banks. They were bundled up and sold as bonds called CMBS, commercial mortgage-backed securities. This is the exact same financial toxic waste that caused the 2008 crash, just with offices instead of houses. These bonds were sliced into tranches. The top tranche was rated AAA. It was sold to pension funds. It was sold to your 401k. The theory was, even if some buildings default, the AAA bonds are safe. That theory is dead. When a building sells for a 50% or 80% loss, which is happening in San Francisco, the losses burn through the lower tranches and hit the AAA investors. We are seeing AAA-rated bonds taking losses. That is not supposed to happen. This means the contagion isn't just in the banks. It is in the pension funds of firefighters and teachers. They are holding the bag for empty skyscrapers they have never seen. Now let's look at the other bag holder, the regional banks. It's not the big boys. JP Morgan and Bank of America have relatively small exposure to this. The risk is concentrated in the local banks, the banks where you probably have your savings account. Regional banks hold nearly 70% of all commercial real estate loans in America. They are massive whales in a shrinking pond. When these loans go bad, these banks don't just lose profit, they lose their capital buffer. We saw what happened with Silicon Valley Bank. That was a duration crisis, interest rates. This is a credit crisis, bad loans. Credit crises are far worse. If a building sells for 40 cents on the dollar, the bank's equity is wiped out instantly. The smart money is shorting regional bank stocks because they know the balance sheets are full of lies. We are likely heading for a wave of consolidation where hundreds of small banks are swallowed by the giants. The optimists have a solution. Just turn the empty offices into apartments. We have a housing shortage. This is the conversion myth. It sounds great on paper. It is a nightmare in physics. I looked at the blueprints. Modern office towers have massive floor plates. They are deep squares. Apartments require windows. You legally need a window in every bedroom. If you turn a deep office building into apartments, you end up with massive dead space in the middle, windowless caves that nobody can legally live in. To fix this, you have to carve out the center of the building. You have to redo all the plumbing. You have to punch new holes in the steel. The cost to do this is often higher than just tearing the building down and starting over. Goldman Sachs estimates that only 2 to 10% of office buildings are actually suitable for conversion. The rest? They are obsolete. They are concrete coffins. They will sit empty until they are demolished. This crisis doesn't stop at the building's lobby. It spills out into the street. This is the urban doom loop. When an office tower is empty, the workers aren't buying $15 salads. They aren't taking Ubers. They aren't paying city wage taxes. The local businesses close. The city tax revenue collapses. When tax revenue collapses, the city cuts services. Fewer police, dirtier subways, worse schools. This makes the city less safe and less attractive. So more people leave, which creates more vacancy. It is a death spiral. We are seeing this in real time in places like St. Louis and San Francisco. The smart money is redlining entire zip codes. They are saying, this city is uninvestable. This destroys the value of everything nearby, including the residential condos and the retail strips. Real estate is local, and if the local is dying, the real estate is worthless. But where there is blood in the streets, there is opportunity. The smart money isn't just running away, they are raising cash. Blackstone, KKR, Starwood, they are raising distressed credit funds. They are preparing to play the role of the vulture. When a bank finally sells a $100 million tower for $20 million, the vulture swoops in. At $20 million, the math works again. So here is the verdict for you. 1. Avoid REITs exposed to office. They are the zombie companies. 2. Be careful with regional banks. Check if your bank is heavy on CRE loans. 3. Cash is king. In a deflationary crash, the person with liquidity calls the shots. The skyline is changing. The old monuments are falling. Make sure you aren't standing underneath them when they do. This is the smart money wisdoms. The future belongs to the owners.